Welcome to this latest in our series of videos introducing technical indicators. In this video, we're going to continue to explore oscillators. We're going to talk about how oscillators are considered leading indicators. We'll explain what that means. And we're going to take a look at the relative strength index, the RSI. We'll explain how that works and a basic use of that oscillator. So do keep watching to the end of the video so that you get to learn about that. Hello, I'm Peter Martin with Trading 212. And we add tutorials about trading the financial markets to YouTube on a regular basis. If you haven't already, make sure you subscribe to our YouTube channel. You can do that just by clicking on the red subscribe button, because that's a nice and easy way to find out whenever we've added fresh content to YouTube. Well, in our previous video, we talked about oscillators in a general sense. We talked about how they move, and we briefly introduced the concept of overbought and oversold, which we're going to return to later on in this video. So one important thing that we didn't cover in the previous video, and really this comes under the heading of why use oscillators, is that they can give advance warning of key changes. And this means that they're considered to be what we call leading indicators. To explain that a bit more, let's look at some general terms for two different types of indicator. In the world of fundamental analysis, when we look at economic indicators, they can be classified according to how they change in relation to the business cycle. And there are three types: leading, lagging, and coincidence. Now, with technical indicators, it's more simple, and we can class them as either leading or lagging. Now, a leading indicator is one where the indicator's value moves or changes before the market price, which is to say that it's thought to have some kind of predictive qualities. Conversely, a lagging indicator is an indicator where the value of the indicator moves or changes after the market price moves. And the use of these is generally as a kind of confirmatory role, i.e. to confirm that what you think you're seeing in price actually has occurred. So this is to show you a representation of what we might expect as an ideal performance of a leading indicator. So here is our price chart, and let's say that our leading indicator is going to give us trading signals. And so what we would expect for an ideal performing indicator might be to give us a sell signal here before the market turns and reverses and heads lower, a buy signal here before we get the rebound, a sell signal here before the market turns lower, a sell signal here before the market turns lower again, and a buy signal here just before we get a bounce. So each time those signals are leading the change in the market by a little bit, giving you some kind of prediction of what might happen. Now, of course, in reality, an oscillator isn't going to perform ideally. So a problem with any indicator is that you can get fake signals, as we mentioned in the last video. I would say that generally speaking, that's more of a problem for leading indicators than it is for lagging indicators. So there's a bit of a trade-off in that leading indicators, when they are right, are going to give you a head start. You can get into a move early, so that's the positive. But on the other hand, a leading indicator tends to throw fake signals your way quite frequently, which requires some kind of judgment to avoid the fake signals or some risk management skills to cope with positions opened on the back of the fake signal. So that's the negative. Whereas a lagging indicator tells you after the fact. So the negative is the timing, and you miss out on some of the move. But the positive is what I've described here as signal quality. When they're used as a confirming tool, you're less likely to get faked out, in theory at least. So having talked about oscillators in a general sense, let's now move on to look at something more specific and take a look at the relative strength index, or RSI. Here we are in Trading 212's web app, looking at a daily chart of Sainsbury's, and at the bottom of the chart I've got the rate of change oscillator, which is the oscillator we looked at last time. What I'm going to do is just go to indicators and then oscillators and select the relative strength index. So here it is, the RSI, the relative strength index. And we've got a few more options to play with than when we looked at the ROC. We've got a default period of 14, we'll leave that as it is, and then we've got regions for overbought and oversold, and they're set at 70 and 30 as defaults, and the rest are to do with how the RSI looks and whether we're applying the RSI to the close, the open, the high, or the low. So I'm just going to leave all the defaults alone and click confirm. There we see it added at the bottom of the screen, so we can add more than one oscillator at one time if we so choose. And there we can see some differences to the rate of change oscillator. Whereas the rate of change had 0 in the middle, which it was oscillating either side of. The relative strength index oscillates between 0 and 100. And then we've got these overbought and oversold regions marked on at the levels that we said, 30 and 70. So let's explain how we calculate the RSI. So the relative strength index, the RSI, is an oscillator that measures momentum, just like the ROC. And the man who invented the RSI was a chap called J. Wells Wilder. He described momentum as being the velocity of directional price movement. So it's not just whether price is going up or down, it's how fast it is moving up or down. Now, before we get into showing how the RSI is calculated, I would just say that it is quite an involved process. So no need to get too hung up in that. I think it is instructive to see the various steps involved. But when it comes to actually using the oscillator, Trading 212's app is going to do it all instantly and automatically for you. So you don't need to worry too much about the numbers, but it can be useful just to have a basic grasp of the principles that are being employed. When we're calculating the RSI, we need to first define a characteristic that is called relative strength. And the relative strength equals the average, the arithmetic mean of the closes up over our n periods of time. And then we divide that by the average of the closes down over that same period of time. So as I said before, the default value for n, the number of periods, is 14. That's the number that was recommended by J. Wells Wilder, the person who invented the RSI. And let's just run through some completely arbitrary numbers to try and illustrate the calculation, just to show how it works. So to get an initial value, we'd have to look back over 15 days to get the 14 periods. So here are some changes that I've made up. So the closes of some fictitious market, and then we have the change on each day. So what we do first of all is to tot up the up changes. So +1.5 and +2.5 gives us 4, and then 5, 7 and 10. So we've got a total of 10 for the ups divided by the 14 days that we're looking at. It gives us an average of 1.4. And then we do the same with downs. So -2, -3, -4. So we've got 5 in total, divided by that 14 again. So the average of our downs is 0.36. And then we said that the relative strength was the average of the ups divided by the average of the downs. So it's 1.4 divided by 0.36, which gives us 3.89. And then finally, to calculate the relative strength index, we're going to plug in that relative strength number that we've come up with into this equation. So we had 3.89 for the relative strength. We add that to 1, that gives us 4.89, and then divide that into 100, gives us 20.45, and then subtract that from 100 to give us 79.55. As I said before, these numbers are completely arbitrary, but it's just to show you the process you go through. Really a crucial thing that's going on here. This whole step with the hundreds is to make sure that we get a number that varies between 0 and 100. Now, J. Wells Wilder, who invented the RSI, actually described a number of uses for the oscillator, but seeing as this is an introduction, I don't want to go into information overload. I'm just going to stick to the simplest and easiest to understand use for now. And so a basic use of the RSI is for indicating tops and bottoms. When the RSI goes above 70, that suggests it may be a top, and that is what we call overbought. And when the RSI falls below 30, that suggests it may be a bottom, what we call oversold. And if we go back to the app again, and this is a chart of Sainsbury's, and it was picked at random. If we look at the most recent overbought region, it did do quite a good predictive job of predicting the top before it was reached. The price carried on reaching another top before reversing, but we had a bit of an advance warning there from the RSI. If we look down at this oversold region, it doesn't have quite the advance warning, but it does successfully predict the reversal of direction. But if we look further back, it doesn't do such a great job over here. For example, it gives us an oversold reading here, and that doesn't at all predict what the price is going to do. It carries on falling. And here we can see that we've got a number of oversold readings. The very first one we get does actually coincide with a little bounce. You should be wary of subsequent oversold readings after the first one. They don't mean quite as much after that first one. Well, I hope you enjoyed this look at the Relative Strength Index, the RSI. If you did, please just take a moment to hit the thumbs up button and give us a like. And why not share your thoughts with us on the RSI by sending us a message in the comments section. We do read each one we receive. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. So long.